Thank you all for joining us today. We're glad you're here. This is Business Resiliency Roundtable, Tips for Managing Your Cash Flow. My name is Daryl Hampston. I'm the coordinator of the Small Business Development Center satellite office in West Plains. And with me tonight are Crystal Irons, director of the Missouri State University Small Business Development Center, main headquarters in Springfield. Isla Sloan, finance manager, I believe, of Ozark Small Business Incubator.
Yes.
And Sandra Smart, who's going to be our guest speaker. And she's got a fancy title, so I'm going to let her say that. But before we get too far into this, just wanted to remind everybody that this program, and it's actually the first in a series of 3 programs, is funded through the Howell County CARES Act Small Business Relief Program and offered in partnership between the Missouri Small Business Development Center at Missouri State University and the Ozark Small Business Incubator in West Plains. So, without any further introduction, Sandra, would you like to go ahead and start?
Okay, yeah, sure, Daryl. Thank you very much. So Sandra Smart, I'm a technology and commercialization specialist with the Missouri SBDC at Missouri State University in Springfield. Thank you for joining us tonight. We'll be talking about tips for managing your cash flow. I'm just going to share briefly at the beginning some tools that are available to you as you think through that process to help improve your cash flow. If I can get my screen to advance my slides, there we go. So I want to talk to you about Growth Wheel tonight, which is a tool that we'll look at. And really, it's a 360-degree perspective on your business. 20 different focus areas that you can look at to help determine what's going well in your business and areas that could potentially be improved to help the business move forward. We're going to take a look at a small piece of the financial section you see over in the lower right-hand corner in the operations framework. The first framework that we're going to look at tonight is roads to profitability. Before we get into the actual cash flow, extremely hard if the business is teetering on profitable just barely to help maintain that cash flow. So on this framework, it talks about 4 ways to increase your revenue and then also 4 approaches to reduce your cost. In going through these, more sales from existing clients. You probably heard the saying that it's easier to keep clients than it is to go out and get new clients. So that's one way to look at what your product mix is and increase the revenue from those existing clients. It's also good to look at clients and target market segments that, because of the times and how things are changing, may be more relevant to your business right now, whether it's a product or service business. So you can also increase revenue from sales to new clients. I don't recommend chasing lots of clients there, but really identifying that target market that would work and the demographics that would work for the product or service that you're offering. Upselling is another approach that you can use to help increase revenue where you're selling more products. So that's looking at your product mix or service mix, identifying other opportunities for current or new customers to sell more at a time. And then you can also take a look at increasing your prices. Doesn't have to be a major shift in pricing to really add a cumulative effect to your bottom line. So just looking at those, if you haven't increased your prices or if competition is a lot priced a lot higher, you may have a little bit of wiggle room in there. And then as far as reducing cost, if you're purchasing something from an outside source, so a vendor or a supplier, you can visit with them about opportunities for discounts. You can also look for new suppliers where you might get a cost break there. Always important to review your operating expenses to identify those things that worked for you in the past but aren't necessarily relevant to where your business is at right now. Do you still need those? Can you cut back or reduce those some? Or can you eliminate them, which is the third approach for reducing cost. There could be activities that you're doing in your business that you can completely cut out, allowing that cost reduction, or other expenses that you can cut out that aren't relevant at this time. And then cost efficiency is the last approach, where you're really looking at how can you increase productivity to drop your cost per unit for the product or service that you're offering. When you're looking through this and thinking about profitability, make sure that you're not trying to do everything all at once. Identify, I would say no more than 2, possibly 3 areas that you really think could make a positive impact on your business, and target those instead of trying to do everything at once. One of the decision sheets from Growth Wheel has to do with that profitability review, really looking at your products that you offer, your services, or your customers, and understanding the earning power of those customers. What are they, the product, service, or customer, what are they bringing to the company? This is just an example that has 2 different products and a service from a dummy company, basically, where you're really going through and looking at what that sales price is. If you offer a commission, making sure that you're backing that out, and then looking at that net sales price. And then you look at your cost of goods sold. So if you're purchasing products from an outside source, make sure that that amount is included in there. If you're manufacturing products, what are those raw materials? What processing might be associated with it? What are the shipping costs to get the raw materials to you or to get those products in to your business? You need to make sure that you're including those there. And then time consumed. So whatever time or direct labor for the products or services. Looking for that total cost of goods sold there, and then moving down to the gross profit. What is the gross profit per unit? And then what is that percentage based on the sales price? You can see calculated out here. On the surface, it looks like product 2 and service 1 obviously have a much higher gross profit percentage. And then you're estimating or using historical data to estimate forward on how many units are you selling of that. This example is monthly. So 100 units of product 1, 600 units of product 2, and 150 units of service 1. Calculating your total sales and then your total gross profit. Numbers are great, but percentages really help tell the story and allow you to compare quickly. So then you move down and you allocate your operating expenses to the different products, services, or customers based on the percentage volume. So in this, the categories are very high level. So salaries and wages would be one category. Sales cost could look like a lot of different things. You can lump several operating expense categories in there. And then the rent for your facility, if that's applicable to you. So you can just mark through it and put in what is relevant to the type of business that you own. And what you're really looking at in working through this process is this bottom line. What products or services or customers are extremely profitable to your business that are bringing in the majority of that net profit? And what products or services or customers that you might want to think, okay, is it really worth the time to try to engage that customer? Or should I be focusing or moving toward a different demographic or a different group of customers, or even products and services? And you can see here on the bottom, the dollar amount, total contribution to the net result, $99 for selling 100 units of product 1 that sells for $50. That's not very good. And this directly ties into your ability to cash flow the business. Looking at product 2 and service 1, a little over 4,000, a little over 3,000 there. So, okay, that's some money to the bottom line, allows you to potentially have a cushion there. But looking at the percentages, 1.3% is the contribution for the sales in product 1 that you have. So in looking at this, does product 1 really fit? Do you need it? Is it something that your customers are coming in and buying product 1 and you're able to upsell them and include product 2 and the majority of your sales include that? Or are people coming in and just buying, product 1? It's a very long haul to get to profitability and to be able to cash flow your business. If you look at product 2 and service 1, their share of the net to the bottom line is over 98%. So those would be two areas if I was looking at this that I would say, okay, let's focus on those. What are we doing right there? What additional products or services can we add that would complement those, help increase the profitability of the business, and then also help with that cash flow. Here is a cash flow budget decision sheet from Growth Wheel. This is set up on a weekly basis, really for companies that are tight on that cash flow and trying to make sure that they're managing their cash appropriately. You can take a look at it and mark through the week and put month in there if that's more applicable. But it's really looking at what money do you have coming in at the payment section at the top, and then what money do you have going out at the payment section at the bottom. And the calculations in the lower right will show your balance prior to the payments and then the balance after payments, so you know what that looks like cash flow wise for your business. Here's another example of a cash flow statement through the SCORE template that you can use for budgeting purposes. There are inputs that go into it, and it generates the information with that beginning balance. It shows the cash that's coming into the business, whether that's cash sales or you offer terms to your customers. That could be, 30-day terms, could be 60, could be longer than that. But this template takes into account the timing of the cash flow. So when you're going to have that coming into the business. And then the next section goes down to the outflow. What cash is going out of the business, broken down into three major categories: the investing activities, the operating activities, and then the financing activities. This allows you to see the cash that's going out of the business on a monthly basis in several different categories, and it helps you manage your cash more effectively. It helps you identify potential problems when you may have a negative cash flow and you need access to additional capital. It just helps in the planning process so that you can identify well before you might need access to additional capital that, yes, I do need access, and you can plan for that and have that in place so that you don't miss a beat. Down at the bottom, it's really easy to see what that net cash flow is. It's either going to be positive or negative. It shows you your operating cash balance because you'll have a beginning balance that goes in month one, and the ending cash balance carries over to month two automatically. You can change inputs in the template, and it will automatically update the sheets in the template and the statements. That's something that if you're interested in, we're happy to send that out to you to let you take a look at it. And also, we're all happy to provide support to work through the template. But it's a great overview to see how that money's coming into the business and how it's going out of the business. In the last decision sheet that we're going to look at tonight, cash management. So how do you improve your short-term cash flow and your long-term cash flow for your business? Several different categories on here, different ways identified to create better cash flow. Some of them may be applicable to your business. Others may not be, depending upon how your business is set up, whether you're selling products or services. But definitely going through the decision sheet and looking at the ways that might be applicable to you, and then rating those. Is it very applicable? Yes, that's something that would provide a great benefit right now. Mark it as a 1. Might be applicable to my business. Mark it as a 3. If it's not applicable, don't include it on there. And then off to the right-hand side, you need to jot down how are you going to carry out that initiative if it's a good fit for your business. Who's going to be in charge of it? Just some high-level key steps so that you can move the process forward. So for collecting money from your customers, if you're offering terms, so you've got accounts receivable, you can shorten your terms. That could potentially be an option. Some industries, it's a great option. Other industries, it's not, because all of the other competitors in the market may be offering 30 days or 60-day terms. And if you say, okay, I'm going to shorten my terms back down to 15 days, you may have some clients that leave you. And if those are profitable clients that you've identified working through the previous decision sheet, you have to balance that out. So you could shorten your terms of payment. You could streamline your invoicing process so that you're using digital invoicing at the time of purchase. Again, if you're offering terms to your customers, You could introduce advanced payments for new customers as you bring those on. Really reviewing your customer base, those that you're offering payment terms to, and deciding how to move forward on those. You could improve your reminder procedures. So sending just a friendly email out to customers to let them know, hey, you've got this coming up in 10 days or 5 days, so that it's on the top of their radar. Oh yes, that's due. I need to make sure I get that paid. Definitely making sure that you're including interest payments on any overdue receivables that you have, and clearly stating that on the invoice. And then also you could think about offering cash discounts for immediate payments. That would help improve your cash flow. And that's a cost benefit analysis on, does it help improve your cash flow enough? Is it worth it? And then determining what that discount might look like. When you're working with vendors or suppliers, you can talk with them about potentially extending your terms. Let's say you have net 15 or net 10 right now. You could visit with them about the option to potentially extend those to net 30. Definitely improving your cash flow if you have the ability to do that. If you have invoices and you determine that cash is really tight, communicate with your vendors and suppliers to see if you can break up and make the payments over a period of time instead of by a specific date. The next one on here, make installment agreements with tax authorities. If you're in that situation, definitely reach out and get the installment set up, but try to manage that cash flow so you don't get in that situation, because it does limit your ability to access additional funds in the future if you owe federal or state taxes. And then you can also, in looking through the operating expenses that we talked about earlier, ways to reduce cost or spending for the business. Are there things that you can eliminate, things that you can reduce based on where your business is at right now? If your business has inventory, and this is applicable to you, you can take a look at your inventory levels. Are they where they need to be? Could you reduce those? Do you have some obsolete inventory? Go ahead and discount that, get that out the door, get that cash coming in instead of your cash being tied up in that inventory. When you're ordering from your suppliers, you can think about smaller order sizes. So sometimes suppliers or vendors will say, hey, we've got this special. If you buy $2,500 worth of product, we're going to give you free shipping. You definitely need to take a look at that and say, do you want to have that $2,500 in cash tied up for, let's say, 6 months, because that might be 6 months worth of inventory to save $200 on shipping or even $300 on shipping? Or would it be better for you to purchase in smaller quantities? You still get a reasonable price that you're making money on, but you don't have all of your cash tied up in that. You can also look at changing or reducing the minimum reorder levels. So if you have products that you have it triggered when it gets down to 5 items, you're going to go ahead and reorder. You may want to bump that up to 8 or 10 items, depending upon how long that inventory is sitting on hand. You can charge a little bit more for the products or services that you offer. And then, you could utilize consignment if that makes sense for your business. Doesn't necessarily make sense for all businesses. And there's definitely a trade-off there in managing the consignment portion versus having some cash tied up in inventory. For capital, if you have assets that you're using rarely or that you don't use anymore, definitely you can sell those to help increase the cash flow in your business. If you have equipment that you use sometimes, but you're paying a large amount on it, or you have an opportunity to sell it and lease something that would bring the cash burden on the business down, that would be an option. And then leasing production equipment, inventory, if that's applicable to your industry, or vehicles. One thing I will say, if your business for vehicles is high mileage, while a lease may be cheaper on the front end, when you go to turn that car back in, something to keep in mind is you have to pay additional cost per mile over the allotted amount, and that can get expensive really quickly. So you're saving cash initially, but you end up taking a lot larger hit later on. So just something to think about on that. Loans, looking at getting loans from your bank, potentially, from family, friends, whatever might make sense. In talking to your bank, if you're in a cash flow crunch, about overdraft protection. What options do they have for overdraft protection? I've seen in cases where people have had overdraft fees into the several thousands of dollars. Makes it really hard to cash flow a business when you're trying to deal with that and you're always playing catch up. Is there something that you can work out with your banker that will minimize those fees and will help you retain more cash in the business? So communicate with your banker. Factoring is another option, very relevant for some companies, not necessarily relevant for other companies, and a lot of different options out there. The fees that are charged vary, so that could be something that you could look into to help improve that cash flow. So you're getting that money in days instead of waiting 30, 45, 60 days to have the funds in the business. If you're having trouble with your bank loan payments, definitely talk to your lender, visit with them, see what options are available to help extend those payments out and improve the cash flow in your business. And then you could also raise capital for the business from investors, if that's applicable, not necessarily applicable for all businesses. So Growth Wheel talks about, it's one thing to make decisions. So you can make a long list of decisions. And if you don't have actions to go along with those decisions to actually carry them out, a decision is nothing more than something that you just thought about. No relevance or practical application for the business. And with that, Growth Wheel provides 30, 60, 90-day plans where you can list the focus areas, the decisions that you have made, and then the actions that need to be taken associated with those decisions. Have a time frame on it, have a person that's responsible for it or accountable for it, so you can help move the business forward. Okay, so just high level ways to improve cash flow, things to think about profitability wise for your business, and then also looking at the best potential products, services, or customer mixture to help also improve that cash flow.